Well, welcome into the Money Wisdom podcast powered by Johnson Brunetti. My name is Jake Dozer. I'm a certified financial planner and certified private wealth advisor here on the team in Connecticut. Nick, introduce yourself for us, if you would.
Yes, thank you, Jake. Folks, welcome back. As always, I'm Nick Colantuono, certified financial planner up here in our Boston, Massachusetts offices. We're glad you're back with us on this episode of the Money Wisdom podcast.
Yeah, a lot has happened in the past month or so, specifically legislatively. Yeah. Nick laughs because I think that that's an understatement. I feel like if you turn on the news for 14 seconds, whether it be through your phone, iPad, laptop, computer, television, whatever it may be, you've heard about this big, beautiful bill, right? And regardless if you think this bill is beautiful or a behemoth or any other B related
It is big. It is big.
It's big.
887 pages.
That's right. We don't have to agree on whether or not it's beautiful to identify that it is big. And we're not here to argue the merit for or against that bill, but we are here to do our best to demystify it and to talk about how will this big, beautiful bill impact your taxes. Needless to say, there's nothing certain in life but death and taxes, Benjamin Franklin said. And I don't want to pay taxes. And unfortunately, being in Connecticut and you, Nick, in Massachusetts, all we see is tax conversations a lot of times, whether it be income tax from the feds, from the state, whether it be sales tax, whether it be FICA tax, whether it be excise tax on our cars, whether the real estate tax, et cetera, et cetera. So without further ado, let's talk about this. Nick, one of the biggest things we were talking about before we started taping was the fact that tax cuts have been extended. Fill us in on that, and what do we need to be thinking about that?
Yeah, I think the easiest way to unpack the one big beautiful bill, the biggest change to come of it is not even a change at all. What is really happening is the current tax code that we have in place, and of course, this was a tax code that came as a result of the Tax Cut and Jobs Act back in 2017. Putting tax rates where they are right now, which, for all intents and purposes are at, if not near, historic lows in the history of our country. So the biggest change to come from the one big beautiful bill is not a change at all. It's just stating that the tax code we have now is going to remain in place at least through the end of this current administration, so 2028. So, from a planning standpoint, how are we looking at, the oldest saying in the book is the situation is the boss, right? And coming up until this recent legislation, it was always, let's get out in front of the tax changes that could happen if tax rates are going up. And whenever we do our educational events or our dinner workshops, I often make a point to pull the room and just ask people, raise your hand if you think taxes are going down in the future. And of course, we all have a nice laugh because not a single person in the room raises their hand. So the concern leading up to this was, tax rates are going to increase. The brackets are going to change. You're going to be paying more in taxes later than you could now. So, I think at least one of the things to come from this bill was just a little bit of a sigh of relief that the current tax codes and the current tax rates that we have, which, let's face it, folks, are very favorable, will at least be in place through the end of this administration. So I think that was the biggest thing to uncover there. And, as we kind of joked around kicking off the show, the bill is certainly big. It was 887 pages. So there's a lot in there. And frankly, a lot of it goes over my head, even, being in this business for my entire career. But I think, if anything, it just opens the door for a lot of our clients who have come out of those high earning income years and who now find themselves in pretty favorable tax brackets, maybe the lowest tax brackets they've ever been in their life. The window of opportunity to be planning for Roth conversions, planning for legacy, planning for gifting, that window just got really opened up as wide as it could, at least for the next, 3-4 years. So everyone out there, make sure you're having conversations with your financial planners. Make sure you're having conversations with your advisors to see what, if anything, can be done to take advantage of this new window of opportunity.
That's right. And Nick, you said right at the beginning, this is now the new normal, the permanency of these tax cuts. 2017, they're passed. They were set to sunset or expire at the end of 2025, the time of this recording, December 31st, 2025. And there was a lot of speculation is in January 1st, 2026, what happens? Well, default, what was set is the tax cuts were set to expire back to what they were pre 2017, which would result in tax brackets going up on the same amount of income. Your standard deduction would go down, your tax brackets would go up. So you're getting more taxes on the same dollars. So they've now made permanent, at least as permanent as legislation can be until the next bill passes. As Nick mentioned, 2028 certainly is another year coming up on the horizon. Parts of this bill expire at that point. These, by default, and we'll talk about that in a minute, parts of this bill don't expire at that point. But again, of course, future legislation could change that. And so it's one of these things is when things are on sale, you should shop for them. Right now, taxes are on sale. And so what that translates to is that it's a unique opportunity, as Nick mentioned, to plan ahead and to proactively address taxes. If I know that taxes are never going to go down realistically, and I know that taxes are inevitable, then it's not a decision of paying taxes or not. It's a decision of when to pay taxes so they're the cheapest. And our goal at Johnson Brunetti is to say between now and the time you pass away, how do we get you to pay the least amount of taxes? And for what's left over, how do we get your heirs to pay the least amount of taxes? So agnostic of who writes the check, how do we write the smallest amount of checks? And so what that translates to is you have to have a tax strategy. If you're in your working years, identify what tax bracket you're in. Identify what your effective tax rate is. Compare that to what your income should be in retirement. Understand what your cash flow, your expenses are, so that you could give yourself an apples to apples comparison. Keep inflation factored in. And then say, okay, when would I rather pay taxes? At this higher place or this lower place, or vice versa? That should direct the type of contributions to your retirement account you're making. And then down the road, or potentially now, in addition to your contributions, you should be evaluating conversions. Should you be converting money to Roth IRAs? Nick and I have spent some time over the past few weeks actually talking about specific scenarios off camera. And of course, we won't give you the details, but where proactive Roth conversions, assuming income needs remain static, would save clients hundreds of thousands of dollars in taxes over their lifetime. And it's an exciting thing to be able to see because we're able to say, hey, look, by controlling when we pay these taxes, we can pay less. Certainly taxes will go up and over the time, but that only helps your Roth conversions because you paid them at a cheaper time. And so there's never a bad time to start controlling taxes. How do you control it? Make a plan, have a strategy based on your situation, and know what the laws are changing. Legislative risk, which is the fact that laws change over time, are a real threat. And so if we know we're in a valley of taxes, let's take advantage of that. Yeah, that's the biggest thing in the tax bill, really, I think, Nick. Yeah, I don't see anything else that's jumping off the page at like a majority of folks. There are some other things, but I think across the board, that's probably the most largely impactful thing. Would you say?
Mm-hmm. Yeah, the deductions have changed a little bit. Standard deduction and marital deduction have increased, of course, with cost of living adjustments as they tend to. But one of the biggest changes, aside from the rates themselves, kind of becoming permanent, although nothing's permanent in Washington, was just the fact that for people who are over 65, your additional deduction above and beyond the standard, whether it's single or marital deduction, has now increased to $6,000. So if you think, okay, a married couple filing joint taxes, you get about a $30,000 deduction. But because if you're both over 65, that's an additional $12,000. Like that's $42,000 in deductions. So, not to just bring it back to the idea of Roth conversion planning, but, that same married couple filing joint taxes, you can have adjusted gross income pretty darn close to like $130,000 and still find yourself in a 12% federal tax bracket. Like that's really powerful,
That's
especially if you're just thinking about these things and you've got plans in place for how to take advantage of it. So that additional deduction is really going to help a lot of people. And I know there was a lot of conversation going into this beautiful tax bill, one big beautiful bill, saying that it was going to eliminate taxes on Social Security. And this is where you really have to kind of read the fine print because we now know that that is not the case, right? You still owe taxes on your Social Security. Here in Massachusetts, you don't. But federally, you owe taxes on it. the that additional $6,000 deduction for most folks over 65, the way we've come to sort of unpack it is you can think about that as really eliminating taxes that about 90 to 95% of people would pay on their Social Security.
Mhm.
So they're giving you a little extra deduction in one area that ultimately might eliminate or at least offset taxes that you're on the hook for in another area. So, of course, they all try to put their spin on things and they say it eliminates the taxes on Social Security. And for many people, that is the case.
Right.
Just be mindful, your Social Security is still federal or still subject to federal income tax, but you might get a little extra deduction here or there that will offset it. So
That's right.
that's something to be mindful of as well. I know they also made some changes to the educational savings accounts that a lot of our clients are taking advantage of. Maybe not for their kids, but for the benefit of their grandkids. The 529 plans in Massachusetts. We have the MIFA U Fund, which again, it gives you the ability to save money for qualified educational expenses. And, up until this one big, beautiful bill was passed, those expenses were pretty limited. It was either 2 or 4 year educational expenses and really anything associated with them. So think tuition, room and board. I'm not sure if it covered like meal plans, but I would imagine it would, because usually that's like tied into the whole, the overall bill. But what they've done now is they've really expanded how those 529 plans can be used. There was a new law that went into effect last year, which said that any unused 529 plan money could actually be rolled into a Roth IRA for the beneficiary. And, they cap it. They only allow you to do about $35,000 per beneficiary. But in addition to that, well, now we're finding out you can use a 529 plan for really anything that, you and I being CFPs, Jake, we could be taking money out of our kids' 529 plans to pay our CFP dues every year.
Right.
I don't hate the sound of that. But, again, so whether it's professional certifications or just continuing adult education, they've really expanded the scope of what 529 plans can be used for. And I think that's fantastic, because a lot of people were hesitant to put money in because, what if they don't go to college, right? So a lot more flexibility.
That's right. So be cognizant of that, be understanding if you are like our clients, where you're in that place where you're thinking about your grandkids, you're thinking about a legacy, think about how am I leaving this legacy to them? A 529 plan, a gifting strategy, a legacy plan really is what that should be under the umbrella of. Should be a conversation, whether it be a 529 plan, whether it be annual gifting, whether it be a lifetime gifting. A lot of what we do is help not only save income taxes, which the Roth conversion conversation piece talks about, but also gift and estate taxes. And that segues us into another piece that comes in the bill, is that the level at the federal level at which estate taxes would be present, meaning the taxes of your estate from you when you pass to your heirs, was set to expire. And that level has been made permanent, again, until the next bill comes. But at this point, it's $15 million federally per person, indexed to inflation. In the state of Connecticut, at least, Massachusetts is a very different story, much more unfavorable, but which Nick can allude to in a moment. But in Connecticut, the level follows the federal level. And so what that means is if you're tuning in and you're in that high net worth category, you have $5 million or more. You say, I thought it was 15 million. Well, remember, $5 million grows pretty quick over time. And unless you're using a lot of money, it might grow up that point. First and foremost, congratulations on being there. We work with clients like you all the time because it's a good problem, but you have a whole different set of problems that come with taxes that can sit on top of income tax. And between estate and gift taxes can oftentimes decimate 50% or more of a portfolio, leaving it to the next generation. And so we'd love to be able to help you be able to understand and unpack that piece. So if you are in that case and you want to know how estate tax thresholds impact you potentially and ways to avoid or mitigate that and ways to proactively plan for that, let's talk. Finally, one of the other things that is impactful, which is a big question mark on a lot of people's minds and how this is going to roll out, is Medicaid and Affordable Care Act cuts. Nick, walk us through that a little bit, because I think that this one might not directly impact people instantly, but I think it will indirectly impact folks. Talk to us about this.
Yeah, I think it ultimately comes down to income, right? A lot of those premiums, whether it's health insurance premiums, if you're just not yet 65, you're not eligible for Medicare, so you have to go in private pay for insurance. You go to the Massachusetts Health Connector. Your premiums on the Health Connector are based on your income. So again, those are all things that are subject to change. Obviously, we know the stress that these types of programs are under. You kind of think of the big three when it comes to where government spending is going, right? I mean, it's Social Security, it's Medicare, it's Medicaid. So, yes, these tax cuts do some things to keep the current costs for most of our clients in check a little bit, but those are things that could always be changing. And that's where, you might find your insurance premiums, you might think they're high now, but who knows, maybe 2-3 years from now, you're renewing those plans and those premiums could certainly be going up. So everyone should just be aware of that. There are costs associated with these plans and costs associated with administering them. And of course, the costs that we feel as consumers are just the premiums we pay. And again, those premiums that we pay are a direct reflection of the costs that it takes to administer these programs. And, you think of something like Medicare, right? You're eligible at 65. There's 12,000 people a day, Jake, turning 65. And that trend is going to continue for the next 10, 15 years. And, so again, you think of the pressure and the stress. We all love the idea that taxes are remaining low, but then where's the revenue coming from to support these other programs? So changes have to be made in a few ways, whether it's, again, generating revenue through increasing taxes or keeping more money in the door through, you hate to think of it this way, but like cutting programs. And it's just such a tricky thing that they're forced to deal with down on Capitol Hill. So, whenever these bills get passed, there's some good stuff in there. There's some stuff that makes you think, ooh, did that really need to be in there? But, as we started with, situation is the boss, and here we are. And if you're out there and you feel like you don't have a plan and you don't have anywhere to go for advice and guidance when it comes to this stuff, that's what we're here for. This is what we do. So we've actually got a really good resource that we'd love to provide everyone who's tuning in today. So again, this guide is really all about taxes. We titled it correctly, are you paying too much taxes in retirement? So if you want that guide, the Are You Paying Too Much Taxes in Retirement guide, text the word offer, OFFER, text it to us at 800-757-0436. Someone on our team will get that Are You Paying Too Much in Taxes in Retirement guide right out to you, because that really encompasses everything that we're talking about today.
Hopefully today's conversation has been helpful. In a nutshell, tax rates are staying the same at an income level federally. Estate tax thresholds have adjusted and been made permanent. Medicaid and Affordable Care Act cuts have been made. 529 plans have seen adjusted and increased flexibility. Seniors 65 and older are getting an extra deduction. These things are changing all the time. Make sure that your plan is flexible enough to be able to encompass these ongoing changes. Hopefully today's Money Wisdom podcast has been helpful. As always, my name is Jake Dozer. Nick Colantuono is, as always, my co-host here, and we'll look forward to seeing you on the next episode.
Johnson Brunetti is a marketing name for the businesses of JB Capital and JN Financial. Investment advisory services offered through JB Capital LLC. Insurance products offered through JN Financial LLC.